So let's fine tune 16.4, and 16.4 will basically go through some journal entries. Let's understand what we're doing. Okay, guys? Again, if I do it in class, what's the scoop about that? That information that we talk about in class could be on the exam. If we don't talk about it in class, is it going to be on the exam? No. Okay. Stock dividends, but I did tell you I was kind of interested in that, didn't I? Okay? Remember I told you cash dividends, stock dividends? What's that other word I told you about? You could have a multiple choice on that one, okay? Okay, so let's talk about 16.4. The shareholders' equity of Raven Company is shown. Common stock at $10 par, $250,000. Additional paid-in capital on common stock, $150,000. Retained earnings, $200,000, for a total of $600,000. Raven is considering the declaration and issuance of a stock dividend at a time when the market price is $30 per share. Assuming the board of directors recommends a 6% stock dividend, prepare the journal entry at the date of declaration. Then we'll do the journal entry at the date of issuance and the shareholder equity after the issuance. So what we're learning here is we've got $250,000 at how many dollars per par? 10 bucks a par. How many shares do we have? 25,000 shares, okay? So the first thing we need to do is the journal entry at the date of declaration. So this is going to be 16.4, okay? So the journal entry at the date of declaration. Retained earnings. Is it okay that I'm typing instead of writing on the board?
Oh, yeah.
You wouldn't like my handwriting. Okay, retained earnings. How are we going to calculate this? The retained earnings are going to be 25,000 shares times 6% times 30 bucks. Okay? And what is that? $45,000. And then we're going to do a credit for common stock to be distributed of 15,000 additional paid in capital from stock dividend, 30,000. Okay, so how are we coming up with common stock to be distributed 15 and additional paid in capital from stock dividends of 30? If we go back to the problem, we've got 25,000 shares, a 6% stock dividend on 25,000 shares, 25,000 shares at a 6% stock dividend, and the 30 bucks is what the market price is right now. Okay? So if the market price is 30 bucks a share, but what do we know the par value really is? $10 a share, right? So anything over the $10 a share is going to get put in additional paid in capital from stock dividend. Okie doke? Now, the next one that we're looking at is what is going to be the journal entry at the date of issuance. So the journal entry at the date of issuance is going to be stock.
I'm still confused by the 15, how we got the 15,000 and the 30,000.
Stock, common stocks, okay. Comes to be distributed. Okay, so we've got 25,000 shares that we're issuing a 6% dividend on, and currently the market rate is at $30 a share, okay? So if we take $45,000 and we divide that by $30 a share, how many shares is that? $15,000 shares, or 1,500 shares. But what is the par value? 10. Guys, it's really not tricky, but it can confuse you. Remember that the common stock at par value goes in one location, and then everything over that par value goes in additional paid-in capital. Am I confusing you? How many of you get that? Okay? Yes. Okay, you do. Guys, do you hear that I want you to ask me questions? I might not know the answer, but I'll find it out, okay? Hopefully I know most of them. If you know, they say like in a relationship, better to have more good times than bad times. Hopefully as a teacher here, I know the answer more than I don't. That's all you can bet on here, okay? Make sense though? That wasn't a good joke, was it? What'd you say? Oh, was it better than Kenny's? Poor guy. He's not here to defend himself. Okay, so common stock to be distributed is 15,000 shares. Okay, or excuse me, 15,000 bucks. And the next one here is going to be common stock 15. What are we doing here? Do you see in this initial journal entry when we declared it, how we reduced our retained earnings? Because that's what has to happen. You reduce your retained earnings when you declare a stock dividend, don't you? And we're showing common stock to be distributed and additional paid-in capital. We're showing it. But then what happens is when we're actually doing it, we're going to reverse that entry and show common stock being issued. Make sense? How many of you guys get that? How many of you would tell me if you didn't? Good. Yes, you would. Thank you. Any questions? Yes, dear.
So in that first entry, when you're crediting common stock to be distributed,
Yep.
would that technically be like a liability?
Yes, it's technically like a liability. Exactly.
Okay.
Because we're supposed to do it, but we haven't done it yet. Okay? Now, can I go on to C? Am I going too fast, too slow, just right?
I think we're doing good.
Okay. It's your job to tell me though, guys, okay? Doesn't bug me. Next, what is the shareholders' equity after the issuance? Okay, we know what it is before the issuance. You see all our shareholders' equity here? The common stock of 250,000, additional paid-in capital 150, retained earnings 200. What's it going to be afterwards? How are we going to figure this sucker out? Now we've got here common stock, $10 par value. How many shares do we have now? Or dollars worth? 265,000, right? We had 250. We just upped it 15. You guys agree? Then we've got additional paid-in capital on common stock of how much? It was 150. See there how it was 150? And then we increased it, additional paid in common stock. Additional paid in cap from stock dividend. Okay, so additional paid in capital common stock here was the 150, plus we added 150. Let me just do that. Then we added the additional paid in capital from stock dividend. And that was 30, right? But now our retained earnings went down, didn't they? So basically we shifted it from retained earnings. It's still the same amount sitting in there, but we took it out of retained earnings and it's now part of the stockholders' stock. Okay? So our retained earnings goes down to what? 155. But guys, that's weird. Our balance is the same as what it was. Why is our balance the same? We didn't pay out cash and we reduced our retained earnings, but we increased our stock. The balance is still the same in our stockholders' equity, right? We just took it out of retained earnings and increased our stock. Make sense? So if you had a question with a stock dividend, does your total stockholders' equity balance change? It doesn't, does it? Make sense? With a cash dividend, does it? It does.
Yeah, you see that.
Do you understand how that works? All we're doing here is we're taking stockholders' equity. They're both the same. They're accounts and stockholders' equity. We're just reducing retained earnings and increasing stockholders' equity. What are we doing when we do a cash dividend? Reducing retained earnings and reducing cash, right? I'm trying to help you understand the process, okay? So issuing more stock ultimately, gives the stockholders more, but it's really the same pot of money, the same pile here. Okay? Number 2. Assuming instead that a 40% stock dividend is recommended, answer A, B, and C of requirement 1. Darn it, not a 6%, now we got a 40% stock dividend. Guys, no need to worry. We're going to kind of do the same thing here. Okay? What's going to be different here? I'm just going to make this 40% instead of 6%, right? And how's that going to change our number here? 25,000 at 40% times $30 a share. What's this number going to be now? What? 100,000. But if we take 100,000 and we divide it by $30 a share, how many shares is that? Oh, excuse me, 100,000. How many shares is that? How many shares is that, guys? 10,000 shares.
100,000 should actually be
300,000.
We take 25,000 times 40% times $10.
Times 30 is what you have up there.
Okay, I'm doing something wrong.
If it's over 25%, you're supposed to report it par value instead of fair market.
That's what's happening. So, because it's over 25% or 20?
25.
Because it's over 25%, and this is at 40%, we're no longer going to take it at the $30 like I was doing. we're going to now take it at par value, okay? And that's going to make it 100,000, and all of the common stock to be distributed is going to be at par value. It's not going to be at additional paid-in capital, right? Why? Because it's all at par, right? 25,000 times 40% times $10 is all going to go in at par value. And then once it is going to be distributed, what are we going to do? Or once it's distributed, we're going to debit it and credit it all for common stock. Okay? So if we do that, then what is our common stock amount? 350? Because we're not going to have any additional paid-in capital down here. It's all going right into common stock at par value. And what about our retained earnings? How much are they going to go down? What were they? They were, they were at 200. They're going down 100,000, aren't they? So, do you see how our retained earnings, our stockholders' equity still hasn't changed? But we now have more common stock. Our additional paid-in capital didn't change because the amount of it was greater than 20%, or did you say 25? 25%. That's the key. I'm not getting it. That's the key. Remember, if it's 20%, you're going to continue to do it the way we did with the 6%. But once it's 25%, what are we going to do? It's all going to be distributed only at par value, not at fair market value. Or market value is the right way to say it. Make sense? Do we know that trick? Now that could maybe be a trick on a multiple choice. Do you get what I'm kind of saying? Hint, hint. Okay? Are we good there? How many guys get this? I will put on the Moodle the solutions so you can go over other problems like this. You don't need to go over totally different problems because, again, if we go over it in class, you're going to see it. Any questions before we move back to the PowerPoint? Yes, no? Are we good? Okay. So as we move back to the PowerPoint, we started talking about shareholders' equity. How do we account for prior period? So we started talking about shareholders' equity. And shareholders' equity, one thing I do want to just pay a little bit of attention to is if there's restrictions on retained earnings, those monies can't be used to pay dividends. Did you guys know that? Did you go over that? If there is a restriction on monies, they cannot be used to be used to pay dividends. Sometimes for purposes, maybe debt, they have restrictions on retained earnings that they're restricted for a certain use. How many of you guys have taken nonprofit accounting yet? Or fund accounting? Okay.
Wait, what are you?
I wonder if y'all have that in here. Oh, that's interesting.
Can you repeat what you said again?
If there is a restriction in the retained earnings for us on a certain amount of retained earnings, that money cannot be used for dividends because it's restricted for a particular purpose. Okay? Got it? Now, we're going to start talking about the shareholders' equity. In the shareholders' equity, we all know that's part of the balance sheet, don't we? And we started out with shareholders equity just being owner's equity, and then we're getting a little smarter, realizing it can get really confusing. Don't you like how accounting does that? It starts out simple, and it's the same concepts, guys. It just gets a little more involved, right? It's still debits and credits, and shareholders equity still increases with credits, but now we get little segments of various aspects of shareholders equity. Here you can see with shareholders equity that we've got it broken down, starting the period with common stock at par value, and then additional paid in capital. Did you guys talk about treasury stock at all? Treasury stock is that stock that the company purchases back from the public. Why would a company want to do that? To keep from getting taken over. So they're basically tightening up on certain financing purposes. They're bringing in some stock. That would actually be a good. Not that you care to learn anymore. You got plenty, but that would be an interesting little research on articles as to find out companies that do buy back their stock and what incentive they had to get back their stock. See, I like articles that can relate to kind of what we're talking about. Why do they do that? You know, and find out why are companies doing that. So we've got treasury stock. We've got common stock option warrants. So options out there to purchase stock. Then we've got retained earnings. And then we've got other accumulated comprehensive income and treasury stock. So we've got all kinds of different aspects of our stockholders' equity, and issued for cash. We've got issued for exercise of share options, compensation expense for options, and unrealized increase in value of available for sale securities. My gosh, we add our net income, subtract our dividends, and now we end up with our ending balances. So you see, it's become a lot more complicated than just owner's equity, right? So basically, here's part 2 of the slide showing the breakdown of how the stock is laid out here. With our common stock, we're showing the par value. We're showing the additional paid in stock, the additional paid in from Treasury, the option warrants, the capital, retained earnings, and then the other comprehensive income. So it's this exact same information displayed in this manner. Okay? It's the same information, but this is how it's displayed on the financial statements. What is accumulated other comprehensive income? It's net income and something called other comprehensive income. What could it be? What's the difference between something realized and unrealized?
You know what's going to happen versus you don't know what's going to happen.
Realized income has already occurred. Unrealized income, maybe a transaction has not yet technically occurred, but it's unrealized. So for example, let's say my stock, I have some Apple stock that I bought at $30 a share. I haven't sold it. It's still sitting now on my portfolio. Okay, so let me make it this way to help you understand it. So let's just say I have 100 shares of Apple, and when I bought it, it was at $30 a share. Now I don't even know if this is realistic, but just go along with me. So when I bought it, I spent $3,000 on it, didn't I? Now when I get my Edward Jones statement, assuming it hasn't split, or I have 100 shares at $300 a share, or $30,000. Now my profit, I will have an unrealized gain here of how much? 20. Why is it unrealized though?
You don't have the money, it's still in the market.
Poor thing. Poor thing. That's what my daughter does. She just sticks Kleenex up her nose.
It's inevitable. I don't care how I look.
It's okay.
At least
Do you-
I'm in the front.
No one can see you. Do you guys see how it's unrealized? Because I haven't sold it yet.
You just have the potential to make that much.
Right now it's worth that. When I was married to a Northwest pilot, and this was when we had all this stock, and at one time we thought like we were wealthy. Ha ha ha. And then it went bankrupt. Guess what? I still had the shares. But they weren't worth what I thought they were worth. Get it? At one time I had unrealized gains, but I never sold them like I should have. Get it? Unrealized, technically, it's there, but you haven't created the transaction, because we normally record transactions, economic events. You know what I'm talking about? But there are certain things that are recorded at fair value, even though we haven't necessarily sold them. So, unrealized gains or losses in the fair value of investments in available for sale securities. So guys, what happens is when we have a building, this building here, this building probably was, the cost when they initially built it 100 years ago was probably, let's even say $200,000. And then they've depreciated it, so it's probably at zero. But what do you think it's worth, the fair market value? Just guess. Come on, can't you just guess?
$50.
Okay, I was going to say like several million. Just the
Yeah.
land is worth $50 million. But this is not an available for sale marketable security. How many of us could go and buy this? Do you know anyone who would go buy this? Do you get what I'm saying? But there are certain investments that have, through time, the new gap is that certain available for sale securities that anyone can just get on the market and buy and sell with the click of a computer get recorded at market value. This is unique. Doesn't happen very often. But this is one. It's an available for sale security. And this gets recorded at market value. Now, the net is true. The negative is true too. If I buy something at $100 and now it's worth 10, guess what? I got to show that too, because we want a realistic view of really our financial position. Make sense? So this other comprehensive income includes these unrealized increases or decreases, translation adjustments from converting financial statements of a company's foreign operations into U.S. dollars. Boy, guys, we're dealing with a whole nother animal here. We've got various currencies, and we have exchange rates, and they change all the time. So unless we actually have it in U.S. dollars, it's unrealized, right? Get what I'm saying? But we still need to report that, okay, if it's up or down, where it's at. And then gains and losses on certain types of derivative financial instruments. I'll be real honest with you. I'm going to learn about those with you because I don't really know what derivative instruments they're dealing with. But I'm going to learn alongside of you. Certain types of pension plan gains, losses, and cost adjustments. Again, these are investments that are available for sale because most of our pensions are sitting in the market. Got it? So, in our statement of retained earnings, we're going to add prior period adjustments, and then we're going to have plus or minus our net income, and then we're going to minus out any dividends or any reacquisition of our capital stock, and then potentially converting bonds or preferred stock into capital stock. And then we have our ending retained earnings. Guys, it's the same retained earnings, it's just getting a little more complicated. But it's the same thing, isn't it? Do you see how we're just getting more detailed? Don't let it freak you out. You don't have to memorize this stuff, okay? It's still retained earnings. It's just a little more numbers added to it. Okay, so here we've got September 27th of 2009. We've got October 3rd of 2010. Here's our balance sheet as it relates to our stockholders' equity section. We've got common stock, Authorized, 1.2 million shares. Issued and outstanding, 742 and 742.9 shares. So basically, this shows the common stock out there. It's only at 0.001 cent a par value. That's not much, is it? Then we've got all the additional paid-in capital where what most of the money is. Then we've got a piece here of other additional paid-in capital. We've got our retained earnings that we saw earlier of how all this can go, okay? Then we've got all of our accumulated other comprehensive income we just talked about, total shareholders' equity, and then there might be some non-controlling interests of maybe some other companies. We really don't control those companies, but we really have a relationship with them because of the interest that we have within the company. And so what they're trying to do is help us see the big picture of how we are really linked with other companies. Okay? That's something Enron tried not to do, and they kept bad things off their balance sheets. Well, they're requiring us to show where we have interests. They want to see where the relationships are with our total equity. Again, guys, just a stockholders' equity section, just more pieces to it. Okay? The shareholders' equity and related changes. So here we've got, again, the way we're spelling it out as of September 28th, we're just showing, again, the breakdown like we had in the other slide, how we've got it broken down, our earnings, our unrealized gains, translations, all the various amounts. And then we go into our retained earnings of the various losses and stock options, and we come up with a balance as of 2010. Same concept, we're just taking the information from various sources. And our job here is to try to determine where we put various aspects and what we record in the stockholders' equity section. How many shares of Treasury stock were acquired in 2010? At what average price were they acquired? During 2010, Starbucks acquired 11.2 million shares of Treasury stock at an average price of $25.50 a share. So if we go back here and look at our Treasury stock, exercises stock, Treasury stock, sale of common, balance, net earnings. Trying to find where that is. Sale, exercises stock. Well, maybe it's going to show us here. What was Starbucks' other comprehensive income? Ending 2010's balance in accumulated other comprehensive income? Well, we got to go back here to figure out what was their other comprehensive income. Other comprehensive income, 48. It started with 48.4 million, and it ended here with 57.2 million. Am I wrong? 57.2 million. So basically, what we just have to do is the Starbucks financial statements they're showing there, they're just wanting us to identify where we can find that extra information. What were the total dividends declared? The total dividends declared were 267 million, because in 2009 no dividends were declared, but in 2010 267 million dividends were declared. How many shares of common stock were issued for stock option compensation? Well, it's in here somewhere. Don't worry about it. I really don't care. The primary components of net income are income from continuing operations. That's the reason we're in business, right? Continuing operations. Results from discontinued operations. You know how when we create a financial statement, those operations that are now ending, we've got to put that on a separate line item. Don't freak out. We'll go over it, okay? Then, extraordinary gains or losses. This might be due to unique situations. Unique sales of things, losses due to acts of nature, right? Like, let's say Enron, not Enron, Katrina. Don't you think when Katrina hit and there were various things, think about British Petroleum. What happened with all of the British Petroleum? You think those were extraordinary losses with there? it wasn't in the normal course. I mean, it was in their normal operations, but boy, their oil spill was a doozy, wasn't it? Corporations are required by GAAP to report earnings per share information on its income statement. So guys, we did all that work and we still have more work to do? Yes. We just want to know what all that means broken down by share. That's all we care about. So we use this ratio to come up with it. We take the price divided by this earnings ratio, which means the market price of the common stock divided by the earnings per share, the number of shares out there. And the way we are going to determine these number of shares is we're going to kind of weigh them all. Weigh the different stocks and totally what the equivalent earnings per share or number of shares of stock are out there. When using earnings per share information for intercompany comparisons, a user must be sure that calculations are comparable. That is something that is important in accounting, so we can compare within the industry and between industries, right? Or between years, actually. There are two types of corporate capital structures: simple structures and complex structures. So basically, a simple structure is needed in recording earnings per share. We take the net income, we subtract out those dividends, preferred dividends we know get the money. After that, we divide it by this weighted average. So I think what I want to do right now is kind of pause and start working at something. Determining this weighted average is actually easy. This is a good example. Let me do this and then we'll do a problem. But let's say this particular company starts the year with 15,000 shares. Then they purchase or issue 2,700 more shares on March 2nd. So the way you do a weighted average is 15,000 shares are for the whole year, aren't they? This 2,700 shares started in March are actually times 10 months. Then in July, they issued another 3,300 shares. They were in existence for how many months? 6. And then in December 1st, it acquired 600 shares, so that's a subtraction. So the way you can really do this, you see how in January and February, you had 2 months of 15,000 shares. And then from March through June, we added some shares in March, so we increased our shares. We had those for 4 months. Then in July through November, we added more shares. And then in December, we subtracted some shares. So we kind of weigh them based on how many months we had at a certain level of shares. It's not hard to do. We'll go through a problem. So let's kind of stop. Because I don't know about you, but I'm kind of tired of listening to myself. So let's start with a problem.